All right. Good afternoon, everybody. Welcome. My name is Anthony Volan. I'm the owner of The Collective, and we're so glad to have you today. We have a really big group, so I'm sure you have lots of questions, and we really hope we get a chance to answer all of your questions. We're very different brokerage than any other company. We're very passionate about helping people build wealth, and to build wealth, it takes a lot of knowledge. And in our industry, especially, everything is changing all of the time. So we want to be your resource to providing you with the most recent things that you need to know about what's happening in the market. So today's seminar is specifically for home buyers. And we do other seminars as well. So in 2 weeks from now, I'll put all this in the chat. On February 18th, we have a seminar that is just going to be on credit. So everything you need to know about credit will be featured at that seminar. So that's going to be on the 18th at 5 o'clock. And then we have one for home sellers in March. And if you're looking to invest in real estate on St. Patrick's Day at 11 a.m., we're going to teach you all the basics of investing. It's called just Investing 101. We'll teach you what cap rates are, GRMs, expenses, how much rent you need to get to make it be justifiable in order to purchase a certain purchase price, and so on. So we're going to go through all of these types of scenarios at that seminar. But today we're going to be talking about buying a home. And of course, one of the biggest pillars to buying a home is understanding financing and credit and down payment options and what your income needs to be. We'll talk about the whole escrow process of when you write an offer, from multiple offers to hot neighborhoods that are happening at the moment, and how to get through those situations, as well as once you're in escrow, what happens next, home inspections and how to negotiate those home inspections and appraisals and what that means, and all of these things. And any questions you guys have, just type them in the chat and we'll get to you and answer them. We'll definitely have time set aside at the end to answer more questions then. We have it set up today as like a panel with a question and answer with a couple of our lenders. So at this point, I'm going to turn it over to Austin, and he'll get us started and introduce us to the first part of our session with our lenders.
Awesome, wonderful. Thank you everybody for joining. We have a huge group today. I'm very excited to introduce all my friends to you guys. On our panel today, we have two of LA's best lenders, and they're going to help you discuss how you can get qualified for a loan. They're going to touch up on credit, debt to income ratios, down payment options, special programs like if you want to buy a condo with only 3.5% down, or a duplex or even a fourplex with only 3.5% down. All these things are possible, and we're going to touch up on those throughout this Zoom call. So thank you guys so much for joining. After the lenders speak, we're going to share some of the hottest neighborhoods with you that maybe you guys would like to consider in the SoCal, LA area. Plus, we're going to make sure we're going to talk about how you can get your offer accepted, and we're going to talk more about what it takes to really buy your first house and what kind of procedures you're going to have to go through. And during this seminar, all we do is ask that you please keep your Zoom muted and let us speak. And if you have a question, you can type it into the comment section. You can raise your hand and we'll answer questions along the way. And yeah, I'd really just like to kick it off on talking about why it's so much better to own property than it is to rent.
So I'm going to share the poll results with you guys right now, so you can take a little look at that. And can you guys see them? They're on? No? Oh, okay, here we go, share results. That's a little better. Okay, so these are like the three things, right, that are super important. And we're just curious to see, what do you think your obstacles are at this moment in purchasing a home? Credit is one issue. It looks like the number one answer is needs to save for a down payment. So that's typically what we do find, is that that's the most difficult step, or what people think is the most difficult step. So we're going to walk you through some options where it might not be as difficult as you think after we get down to some of the details on down payment options today. And getting higher income, of course, income is definitely a part of it. So we'll be reviewing all of that too. But if you guys don't mind, I mean, right now, I would love for you guys to put in the chat. If you could put in the chat, why do you think that it's important to own a home? Like, what are some of the benefits of home ownership? And let's talk about that first, because I understand that, in this country, the number one way to build wealth is through owning real estate. There's a lot of other reasons too, right? So what are some of those reasons that you've heard or you think of or that you know make it beneficial to own a home? What is that? So you can use the chat below and we'll read off some of those. So first person is investment. It's a great investment. Absolutely. Owning a home means stability. Oh my gosh, yes. A great way to store your wealth as well as hopefully have an appreciation in value. Amazing. We're going to be talking about that. What else do we have on there, Austin?
Stop paying someone else's mortgage. That's a big one. That's a big one. When you rent, you're building equity for your landlord's property, because wherever you're living right now, if you are renting, someone does own that property, and you'd be surprised. It's probably just some Joe Schmo that's walking the street, but you're building up his equity in his property. And that's what renting does. But when you buy, even though it is intimidating to have this big down payment, say you're putting down $50,000, that does sound like a lot, but that money does go right back into you because you're building equity in an asset that you own. So that's my big spiel on why you should buy.
Cash flow, absolutely. There can be in investment properties, passive income. We love that. Combat inflation as home values rise. This is one that whoever said that, who said that? Bill, you're very smart. Thank you for bringing that up. A lot of people don't understand this whole concept. And I know Marty's really great at explaining that. Maybe Marty can talk about that for a minute, but we know we're pumping so much money into the economy right now that there's going to be inflation, right? And this is a great hedge against that. Marty, Natalie, do you guys want to touch on that for a second? Because it's a little higher level thinking, but I think it's an important part of this conversation that people might not understand. Let's get you unmuted, sir, Marty. Come on, you've been on Zooms before.
Sure. Is he not? Oh yeah, he's still on mute. I was gonna let him.
Marty, you can turn off your mute.
Okay, can you hear me? Is this better?
Yes.
And the question was, how does it affect? How is inflation affecting property values? Is that what it was?
No. How does owning a home protect you against inflation, in a sense?
So I mean, obviously, as we know, if you own a property, it's going to be part of that inflationary process. Is going to be your own particular home as well too. It's going to increase in value, and we talked about building wealth and having equity into a property is, you're riding that up. I mean, at the end of the day, there's possibilities of inflationary market ahead of us, which we're talking about. And a lot of people in the economy are saying that we don't have inflation at the moment in time. It's inevitable when interest rates are so low. It's going to be ahead of us. It's very helpful for you to get into these lower interest rate loans right now to hedge yourself against from the increased interest rate markets, because once we have inflation, the only way to control inflation is to increase interest rates. And when you're now all of a sudden pulled out of the marketplace because if the inflation is kicked in and the rates go up, your buying power drops with that. So it's a little high level, but basically what we're trying to say is right now with the interest rates being so low, you should be locking in a payment that's going to stay constant for you for the next 30 years. Once inflation kicks in, all of a sudden that is no longer the case. You're going to have a much higher interest rate. It depends on how bad the inflation is, obviously. So, but having done this for so many years, this is up ahead of us. It's inevitable, and and values always come back up within an inflationary market as well. So, just wanted to make sure that you guys knew that there's going to be a benefit in locking it in at a lower interest rate and riding that wave up with the equity as well. And
then, I mean, people are asking, is it a good time to buy now? And this is part of the conversation that, yes, it is. It's not just because interest rates are low at the lowest level. That's a huge part of it, right? But it's also because of what will happen with inflation and how that affects your investment. So thank you for answering that. But absolutely, it is a great time to buy right now, especially because interest rates are so low. They're the lowest they've ever been. Properties and the affordability index for Los Angeles and for I think pretty much all over our country right now is lower than it's been, or actually it's better. The affordability index, things are more affordable than they've been in the last 4 to 5 years. So if you've been looking for properties or considering it in the last 4 to 5 years, the biggest affordability index is happening right now, and that's because rates are so low. So properties are more affordable than they've been in the last few years, even though prices have gone up in the last few years, right? So a lot of times people think that it's just the price is the determining factor of how affordable a market is, but it's not true. The interest rates are almost a bigger part of that because it stays with you for 30 years. So we're at a very, very lucky time for anyone who's thinking about buying, in the next year, because we know interest rates are just phenomenal and it really helps you out as a buyer. So we're going to be doing a lot of these buyer seminars, and we're passionate about helping you build wealth and getting you into a home if you're not in one. And if you are in one, and getting you onto that next step of, getting into a different type of home, or maybe keeping your condo and buying a home, or getting an investment property. So all of these things are steps that we will be helping you with, through the next 20, 30 years of your investment career. We're here to help you with that. But today we're talking about home buying. So Austin, why don't you take it back away and let's get into a little more details about credit for a few minutes. I know everyone's been asking you about credit. So what are some of the questions you've been hearing?
I do get a lot of questions about credit. A lot of people with a lot of big student loans, like they go to a big university and they rack up all of this debt. And it's really hard because after you graduate, you're dealt with all this debt and you don't have enough money, or you don't have enough financial stability to buy your first property, or even take that first step into real estate. So I did have a question for Natalie. Like, what does make up your credit, and how do student loans affect your credit really?
So credit is made up of only the liens that you have taken out. It is only made up of the loans that you have, right? So credit cards, you basically are getting a loan from a company because they are holding a balance that's due for you. Student loans, car loans, mortgages, these are all debts that you owe somebody back, a creditor back. Things that you don't see on a credit that people think that you might, but you don't actually, are cell phones, right? Because you're not actually borrowing money on a cell phone. You pay that off in full every single month. Your balance gets to zero every single month. So cell phones don't show up, any kind of utilities that you have, any insurance, car insurance, home insurance, things like that, that won't show up on a credit report either. It's only actual debts or loans that you're taking from a creditor that show up on the credit report. Normally, it's a very simple 4 things: mortgages, car loans, student loans, credit cards. Those are the things that show up on a credit report.
Thank you so much. That was very informative.
Yeah, and student loans, so many people have them and they are plentiful now, of course. They can affect somebody's qualifications towards buying. It just depends on which program we structure them in. So I have programs where it barely affects my qualifications, my debt ratios, which is how we qualify a buyer. I can use an income-based repayment plan. So I have a girl who makes a certain amount of money. She's always on deferment. She never pays her student loans monthly. But of course, as a lender, we're supposed to use a debt, some sort of monthly payment, because at some point we have to assume she's going to start paying on them, right? So based on us wanting to use a smaller payment so we can qualify her for more, we can go off an income-based repayment plan. And I have a girl, like I was saying, she's got like $95,000 in student loan debt. And I think I was able to qualify her with an $87 a month payment. And we were able to use that as a lender because that was what she pulled on her income-based repayment plan. So it can affect sometimes, like FHA, they will always go off the amortized worst case scenario kind of. But with Fannie, we have a little bit of leniency there.
What would you say about medical debt? Our friend Lori had a question about medical debt. Do you think you could elaborate more about what that does to your credit?
Well, it depends if it's fallen into collections. So most of the time when we see medical debt on a credit report, it's because it's in collections. Medical debt doesn't normally show up on a credit report. That's something that's paid directly to that medical provider if they're paying it monthly and it doesn't fall into collections. Like if you're on time, you just pay that off monthly, kind of like a dentist. Like if you're not paying the full amount, you pay in installments to them directly. Medical debt is the same thing. It won't show up on a credit report unless you have a care credit card. And in that case, it's a credit card. Any kind of medical debt goes on that care credit card. And that's just like a standard credit card. As long as you pay it monthly, it actually helps your credit. Having debt is good. Having debt that you pay responsibly, it's very good. That's how we rate your credit. If you don't have any debt, how do we know that you can handle it and that you can pay it responsibly? So the only thing that takes a credit report from 0 to 800 is having debt, having those credit cards that you pay regularly on time every month for a few years in a row. Now your credit will be high because you look like a very responsible borrower.
So how many credit cards should you have then? You know, if credit lines are important.
They say a minimum of 3 to get your optimal credit score.
3 credit lines or 3 credit cards, or it doesn't matter?
It kind of doesn't matter, just 3 trade lines, we call them. So it can be, you know, if you want to run the gamut, you can have 1 car loan, 2 credit cards, a student loan in there as well. You know, having 3 or 4 is very good because I'll tell, you know, a lot of people, especially foreigners, are like, this doesn't make sense. I have no debt. That should be great. And I always say, you know, even if, let's say you have 1 credit card that you've had, 1 credit card is easy. It's not, if you're messing up and not paying 1 credit card on time, then how can you handle more debt? You know what I mean? So having 1 credit card, that's not terribly difficult to remember per month. You only have that 1 thing to pay. Having 5 or 6 credit cards that you pay on time every single month, never have a late payment, that's harder. That's harder to remember, harder to keep track of. And then your credit will look better because of that, because you look like a more responsible person, you know.
Beautiful, wonderful answer. Another thing about credit is that a lot of people feel like they're bombarded with all of this debt and they have like this huge mountain that they have to climb, but they don't really know where to start when it comes to fixing their credit. So Marty, I was hoping you could elaborate more on what some people that may not be the most knowledgeable about credit repair, what are the first steps that they can do and how can they maintain a drive to build their credit and repair their credit?
So yeah, part of having credit scores is managing your debt properly is something that you need to understand. Part of your scores are comprised of how much debt you have on each credit card or how much debt you have on a particular trade line. So managing debt is really important, not just only paying back the debt on time or paying it off fully on time, but like some people just can't pay it off fully on every month. You know, you bought those, medical stuff or whatever it was, the family stuff, and then you just racked up some debt and all of a sudden you can't pay it off on a month, the full amount on a monthly basis. And that's common. So, but one of the things you want to do is, like Natalie said, just have a few credit cards and, spread those debts equivocally, if you can, across those credit cards where your balance is not more than 30% of the trade line amount. So let's say you have a credit card that's got a $10,000 trade line or like a credit limit on it, and the customary way of going about it is to have a $3,000 or less balance on that to make sure that it does not affect your credit scores adversely. So now if all of a sudden you've got a $6,000 balance, it's going to start looking like, oh my God, well, this individual is racking up debt and getting close to their balances, or I should say their limits basically. And so my advice would be at that point is take a portion of that and spread it out into another credit card to manage your credit score better. That will actually increase your credit scores. to a place where you're having the same amount of debt on your credit report, but you're actually managing it differently. I'm not sure if that was, the exact answer what you guys were looking for, or is that, was that the question, Austin?
I thought it was a good question. I mean, I thought it was a great answer. And when it comes to credit and you prepare for credit and you want to build your credit, the best thing you could do when you are trying to prepare and build credit is to set a goal. So my next question would probably be, what is the credit score to get like some of the most ideal rates? Or if you can give me like a little bit of a scale between like credit score to zone to zone, what's that credit score that gets you to a good rate?
Somebody, I mean, maybe Anthony could put a poll on this one. I'm not sure, but if everybody knows what credit scores are, and I think Natalie and I probably run into this quite often, is we get people calling us and saying, well, my credit score is 900 or 1,000 or something to that effect. But there's variation matrices that are out there, but those are not valid matrices that people get this information from. So there's so really, the credit score ranges from 300 to 850, 300 being the extreme worst to 850 being the absolute best. So an average credit score that somebody that actually we see on a continuous basis is somewhere around like the 680 to 700 range is a very common credit score. So for a first-time home buyer, even now as the years have gone by, we've gone past and it's also very cyclical. We've gone past the 2008 situations where people have actually improved their credit scores, whereas in 2008, unemployment was high, people were not making their payments. So credit scores fluctuate in some sense, but in this case right now, I would say a good credit score ranges for us anywhere from 680 to 700 is a good credit score.
And what's like a lower end? Because some people know like, hey, I want to buy now, but my credit's 600. Are there programs for that?
Absolutely.
Yeah.
Absolutely.
Okay.
We could go into it very detailed, but I mean, there's government loans that go down to 500 credit score. So that will allow the person to be able to buy a home. But it shouldn't stop you from getting consultation. Don't be embarrassed. This is what our job is to advise our individual how to improve their credit. It's nothing to be, ashamed about. We all make mistakes or things happen in life. And we know these ins and outs of the business, so we can actually help you improve your credit scores within days sometimes. I mean, there's some weird tweaks that you could do that increases your scores by 40, 50, 60 points easily. So
there's one question in the chat from Myra saying, if you get sent to collections, does that ruin your credit completely? So say you have something in collections, how much does it affect your score? When you pay it off, how much does it help your score? Because what are you guys seeing happening with that?
With collections, it's most important that you don't just pay it off, but you pay it off and get a deletion letter. Paying off a collection, it's a good thing, but it doesn't actually change the score that much because it still shows that the collection happened and that it's there. It'll show it zero due, but it doesn't help the score that much actually. If you ever pay off a collection, the most important thing to always remember is you pay it off only in return for a deletion letter. So it's something that you actually have to kind of negotiate with the collection agency. And you get on the phone with them and you're like, listen, I'll pay it off, but I want a collection letter. And if they're not willing to give you a collection letter, then call one of us and we'll get one of our guys to get one for you because you don't want to pay it off without the deletion letter, because then it's like it never even occurred. It doesn't show up on the credit. It goes away completely as if it never existed. That's the only way to handle
Best scenario. The credit is so important and so detailed. If you guys want to learn more about credit, we're doing a full seminar just on credit on February 18th at 5 o'clock. So you'll all be emailed that link to RSVP for that. So we'd love to have you back for that. But now let's get into other myths that a lot of people think. And when we did the poll this morning, or a little while ago here, a majority of people said that their biggest obstacle into becoming a homeowner was saving for the down payment. And most people think that you have to have 20% down. Well, we know that that's not true. So can we dispel that myth and give everyone some of those options and let them know about some of those programs that are available out there for them?
Yeah.
Yeah, there's programs. We should do like tag, right? Tag you're it. So But that, yeah, so there's programs, I mean, it varies. So, it goes from zero down payment, where you don't even have to have any down payment, to, as high as you want to put it down. So for people that have the myth of putting 20% down, there are programs where you could actually not put any money down, and you get your closing costs financed as well, along with, other programs that you could put as little as 3% down, 5% down, 10% down. So it varies. We're going to look at your particular situation and advise you appropriately, because somebody might want to put 3% down, but they have the extra 2%, the 5 to make it into 5, and we'll advise you. We'll give you those options. We'll give you all the variations, and so you can make a decision that's appropriate to you. And of course, being that we've done it long enough, we're going to give you our input as far as what we would do for our own selves to make sure that you're getting advice that's appropriate and that's good for your future, obviously, as well. Sometimes things might seem a little tighter in the beginning, but it's going to make it a much better impact in your future, than it is currently right now. So it might be that you might not go on that vacation this year, and you are going to now make $200,000 in a couple of years when the values go up so much more. So those are things that you really want to keep in mind.
Great. Another question I get asked a lot ago, what a PITI is, and because there are other costs to buying a home besides just like mortgage payments. So I was wondering if either of you two could elaborate more about what that is exactly.
Yes, so I heard PITI. What was there was a second question that kind of,
Oh, no, there's no question. I was just wondering if you could elaborate more about what it is. I get a lot of questions about other types of costs that go along with mortgage payments and buying a home.
got it.
There are a few other ones, and we want to keep everyone informed.
Sure.
Yeah, people basically think that mortgage is their only payment, right? But there's other things they need to consider when they're buying a home. So we hear the word PITI, and maybe some of the people out there do, but they don't know what it means. So what does it mean, and what does
it entail?
Mhm.
So PITI is your principal, interest, taxes, and insurance. It's what we call your full housing payment. So it's not just your mortgage payment, it's your housing payment. So principal and interest is obviously your mortgage payment. Taxes are your county property taxes, and insurance is your homeowner insurance. So that's really what your housing payment is. Now, if you don't put 20% down and you have mortgage insurance, which is an extra payment, which can be an extra housing payment, we call it PITI-MI, or when you have mortgage insurance, I kind of laugh and call it pity me. Did you just hear that, Marty?
That's cute. I like it.
Never heard that before. I love it.
I say that to my clients. I'm like, you've got mortgage insurance, so you have a pity me housing payment.
So yeah, so basically, if I may, on that, if I add on to that, is yes, absolutely, mortgage insurance is on there. A good loan officer should give you a breakdown of all these particular breakdown, each one of these items, so you have an understanding of what each one item is. But to give you an example, to make this a little bit more real, right? So depending on where in the country, where in Los Angeles you are, home prices vary. Anywhere from like, a starter home could be like, I don't know if you could say $700,000 anymore these days, but it could vary from, let's say condo, 500,000 to as high as you'd like it to be. But if you're buying a starter home, let's say, and let's assume like on a $600,000 condo or something to that effect, I mean, you're looking at with putting as little as 3.5% down within, like with the 3.5% down, with PITIA, you're looking at about a $3,400 payment on a monthly basis, just to bring it a little bit more real, to understand what that all entails, because that's now broken down to your principal and interest, taxes, insurance, and your MI. So yeah, I think I just wanted to make sure that people understand that it's not as terribly high as you might think it might be, because rents are, I think regular rents right now are $3,500 anywhere you go, obviously. So
two quick questions in the chat. Does the 700 credit score versus 800 affect your credit, affect your interest rate at all? Do you save much?
Yeah. A little bit. Absolutely. I mean, your interest rate is based on, basically two things, which is the down payment and credit score.
So about, say, a 700 compared to an 800 credit score. If someone's like, hey, I have good credit at 700, but I really want to get it up, is it worth doing that? How much will it help your interest rate?
It is worth it. And whenever I have a client with 700, I'm going to want to try to get them to the next mark of 720 or 740. On conventional loans, anything over 740, it doesn't matter. You hit that 740 mark, you get the same rate as if your credit is 800. Doesn't matter. But if I'm at 718, I'm going to work on getting their credit up a little just so we can get them the best rate possible.
Yeah.
I just wouldn't be afraid of it though. Just it's not a huge amount impact. You're not looking at like you're saving $1,000. So just jump in and get going on the process because like Natalie said, there's things that we could do that can impact your credit score within days. You could be in the 740 credit score within days, obviously, but it's not a huge enough drop in your payments to make you scared to get into the pool, obviously.
Yeah. But if you can do it, do it. If it's easy to do, might as well get above 740. You're golden. Okay, I want to get back
to real quick. It's also the reason why a lot of clients, and I've been getting it a lot lately, actually, will be like, I want to get started. I want to be pre-approved, but I don't want you to pull my credit. I want to get started, but don't pull my credit. I'm afraid to pull my credit. I'm scared. My credit score is 820 and I don't want you to pull it, And I'm always like, well, if it's 820, you have nothing to be scared of. Let me pull it because it's not going to go down. And if it does, it's not going to matter. It's already well above anything that we need. So the fear is when you don't pull it and then you guys are writing counters. And now I'm saying, listen, we're in counters. I got to pull this. And then I pull it. And then there's a collection that you didn't know existed because it doesn't get reported on your bank statement credit report, which is what you're going off of. Do you know what I mean? Which never is accurate. Yeah. And now I don't have
your credit. It's worth it.
It's worth it because
yeah.
Let's
get back to FHA loans for a minute because I want to talk a little bit more about the 3.5% down programs. There's a question in here like, what are the benefits and drawbacks of that? We've been getting a lot of questions about it in Austin's live sessions. On TikTok, and it's top of mind, right? Because this year we expect almost half of the sales to be first-time buyers, and a lot of those first-time buyers are going to be using FHA loans. So let's talk a little bit more about that. Also, being creative. I mean, Austin and I love helping people build wealth, and one thing that I know, Natalie, you've done recently with one of your clients that I thought was so smart was using an FHA loan to buy a fourplex. So with FHA loans, you need to live in them, right? So if you're buying a fourplex, it's to live in a unit and rent out the rest. But let's talk about some of the pluses and minuses of FHA loans for a minute, so people feel a little more comfortable about those.
Yeah, I'll just say on the fourplex, those are very interesting with FHA. They aren't always the easiest to get approved in Los Angeles because there's a debt servicing that has to take place. But FHAs are incredible loans, mainly for single family or duplex. Duplex is incredible. You can buy up to like 1.1 right now and only put 3.5% down on a duplex, which is amazing. FHAs are really, it's an insurance company. You pay that mortgage insurance when you get an FHA, but you can have a credit score of 580. You can have zero money in the bank when we open escrow and zero money in the bank when we close, and you can still close on an FHA loan. If your debt ratios are higher than what is normally allowed, you can close that as well with FHA. I can go to a debt ratio. Some of you might not understand what that is, but it's how we qualify you. I can take a debt ratio to 57 on FHA. So there's a lot of great tools and reasons why we use FHA and kind of shift borrowers into an FHA if they're a little bit more of a, kind of tricky special file, but they're great.
Yep. To add a little bit of that, I mean, FHA was something that was created years ago by Housing and Urban Development to make sure people are getting into homes. Fortunately, the Fannie and Freddie Mac have become a lot more sophisticated, and they've come up with programs that compete and or beat FHA programs these days. So that's why when we're talking about, giving you options, I'm probably going to start with a non-FHA, because FHA is a little bit more of a program that's for people that are credit challenged and also maybe have income challenges as well. So it has a lot more leniencies that will allow you to buy a home, and it's a wonderful program for that. And you'll be able to buy a home with that, which is what, it'll allow you to become a homeowner. But there are so many options. Like I said, earlier, like the 0 down payment, the 3% down payment, and all these other programs that will give you those other options as well that might be a little bit cheaper to get into, and it'll be, for financial perspectives, it would be something to look into as well. But definitely FHA is a program that will allow you, if you have that, oh my God, I screwed up in college and my credit score is now 580 or 600, and I can't get into the regular loan programs. Obviously, it'll let you into those programs, into the homes.
Yeah, one thing I think we didn't mention is that Natalie and Marty are both mortgage bankers. So they're not from Wells Fargo or Citibank or any of the big, banks that you might have your money in. And we tend to find that with our clients, going to a mortgage banker like Movement Mortgage or Arcstone Financial, that it's easier to qualify and you get great rates, and it's just a much better experience overall. So I would recommend talking to a mortgage banker like Marty or Natalie. I put their contact info in the chat, so feel free to check that out and contact them at any time, because a lot of these questions that are going to be asked are going to be very personal. You might not want to ask them on here, or it's just an individual situation, right? So you need to have a one-on-one consultation with the lender to find out if you qualify and what your situation is. For example, one person was posting in the chat, what are the chances I can get approved with 1 year of employment, $9,000 a month income, 10% down payment, 760 credit score? Is it possible with 1 year of employment?
Absolutely. I can take 1 week of employment, depending on where you came from. So if you have had 5 years off and not really an employment history from before that, and you're 1 week on, then we're going to have to chat about kind of an interesting creative way to get it done. But if you're out of school and you're on your first job, and even if you have a gap from out of school, like of 6 months, all I really even need is a contract showing your new salaried income. When we need more than just 1 week of income, obviously, is when you're not salaried. It's when you're self-employed. When you're self-employed, we need a history of being self-employed, because we have to see an average of what you earn, because it's not like somebody is guaranteeing you a salary. It's more of a how much are you working to make your income flow. So we have to see time gone by and a history of it so that we can use an average of it. That's for self-employed, but for salaried, we don't even need a year. We can really just go off your current pay stubs.
Or not even in income. Like we might even just go off of your bank statements.
Yeah.
Our whole goal is to basically make you qualify. So, there's just definitely various different options that you could use.
I hope that this talk has given all of you guys a little bit of hope, because it's not as strict and hard to qualify as some people think. And everyone's situation is different, and there's little tweaks that can be made to help you out. And if now is not the right time for you to purchase, at least you're going to know what you need to do to get on that path. And maybe it's something that you can do and you're ready in 3 months, or maybe it's in a year, or maybe it's in 2 years. But whatever it is, at least you're going to find out what it is for you, and get on that path. So stop building your landlord's wealth and start building your own, or buy that second property. So we're going to switch gears here. Their contact info is in the chat, and they'll be around to answer questions as well at the end. But let's switch gears. And now that we know, say you're approved for a house, what happens next, Austin?
Well, what happens next is that you get to go shopping with us, and that's the fun part. We get to pick out what neighborhoods you want to go to, and we get to talk about what kind of house that you want to live in, if you're going to have kids, if you're not going to have kids, if you want to have a home office, which has a lot of benefits to that aspect as well. But I wanted to ask about like what neighborhoods in Southern California, Los Angeles in particular, what's really hot right now? What's going on? Cindy, maybe you can answer that for me, please. That'd be lovely.
Hi, everyone. I'm Cindy. I'm actually a realtor with the Collective Realty. I've been actually helping a lot of home buyers, especially last year during the pandemic, to get into their first home. So I noticed that many people are working from home right now, so they don't mind, a further away location, further from Los Angeles. They don't mind going to Inland Empire, like San Bernardino County, Riverside County. Those locations are really, really hot right now. I've seen actually more appreciations in those locations as compared to LA. So, but currently I have a few deals in Inglewood. So that's actually a pretty good option too. South LA, Southwest LA, something to think about. Anthony, what do you think?
Yeah, I think you're right. Cindy, like those are really, really hot areas right now. Also, if you go a little bit more north, like North Hollywood, or south, like even farther, like to the South Bay and Long Beach, some of those areas are also a lot of potential to have an increase in price.
You're going in and out, Anthony. Get closer.
Okay. San Pedro, Long Beach, North Hollywood, Inglewood, like you said, those are areas that I see a lot of value to be added sometime very soon. We have a few other realtors here, Karen and Tim. Do you guys have any other suggestions as well?
I would say northeast of downtown is still has blown up, but it's still a long way to go. Highland Park, Mount Washington, all of those areas off of the 110 seem to be pretty hot, but there's still a lot of room for appreciation. Loyal Heights, El Sereno out in the San Gabriel Valley as well.
And the Inland Empire is on fire as well. Like there's just so many great deals to be had there. There's also a lot of those.
You're on mute. Hey, you're on mute.
And then Empire is also a really hot area too right now. We're seeing many, many offers on properties. And I know Cindy, you've done some deals out there too, right?
Your sound is messed up.
Yeah, I cannot hear you.
Go ahead.
What I would say is if you're going to go out with a realtor and start looking, I think you have to know about what's going on in the market, because it's really important that you listen to your realtor, because I'm a realtor with the Collective for many years. We know what's happening out in the market. In other words, right now you're dealing with a seller's market. So you need to know what that means if you're dealing with a seller's market, because that means we have a ton of buyers out there and sellers rule, which means that many buyers are they're going to be a lot of multiple offers. And your agent has been dealing with a lot of listing agents, so they know how you have to do this. And if they're, that going into a property and making an offer that's so low is just going to be a joke. All I'm saying is that they have a sense of how this market is functioning. And otherwise, you're kind of wasting your own time if you ignore it. So I think that's why people say, well, I'll find something myself. You can't, that's really so difficult to do. You can research it and look for properties, but you need somebody to hold your hand through it, because putting in the offer, which would be the first step once you find a property, can make or break the whole situation. So I'm just saying we have a sense of what we're doing.
Beautiful.
Yes.
Beautiful. I hope everyone's enjoying the Zoom seminar so far. I'm having a great time. I want to thank everyone again for coming on and sharing all your great information. It's wonderful. So let's just say that you do put in an offer to a house you want. What's next? Like, what happens after your offer gets accepted? Is there anything that we should know about that? Anything that would concern people? Marty, anyone want to hop in on this?
That noise.
I know.
Yeah.
Everybody's hearing the same.
There's like an echo.
Yeah.
There's echo.
We can only have one person unmuted at a time.
Anthony, there's real problems with your sound.
Okay. Okay, so I'm gonna keep everyone just only
Perfect.
one person at a time. So we're all in the same room. Sorry guys for that. So we'll just try to do one at a time and call on realtors instead of having us all unmuted. So that'll work a little better. So as far as different areas, yeah, there's so many areas that are up and coming, and we just encourage you to explore outside of your comfort zone and get into another area, because everything's changing and developing so fast. And now that COVID has happened, people are thinking about houses differently. They're wanting bigger yards or more outdoor space. So maybe it's okay to not live just as close to work as you were before, and you might be able to work at home for longer than you had thought, and maybe you can live 30 minutes outside of the city in the downtown area and get a bigger piece of property or more space for the same amount of money. So we're here also to help you discover new areas, and we just ask, you know, to be open to that and to share with us what's most important to you in finding those homes. So another thing I think we wanted to talk about, like Austin was just saying, is you know, searching for homes right now is really important, right? And not every website's created equally. The best way to really find homes is really through going through a realtor. It's not through any of the other, you know, websites that you hear online. It's going through the realtor so that they can go directly to the MLS. And the MLS has a system called Coming Soon, where we're able to see listings before they actually hit the market, before they're out to any of the other public sites. So especially now that there's multiple offers in a lot of situations, that's definitely something that you want to take advantage of and make sure your realtor is doing that for you. So yeah, definitely there's a lot of benefits to using a realtor. Once you get into escrow, right, and we find a property, well, I mean, maybe Cindy, do you want to talk a minute about multiple offers? Because, hold on. Talk about multiple offers for a moment, because it's super common right now, right? And there's strategies that we use in order to get through those situations to make your chance as a buyer a little bit more likely that you're actually going to get your offer accepted. So what are some of the things that you've been using or that you see that may help a buyer?
Okay, well, all the offers that was basically were closed. We had to deal with multiple offers. It's something that we cannot avoid nowadays because it's a seller's market. So what I would say is, you know, it really depends on the property, and, you know, it's not just price. So we need to take care of the terms of your contract, and then also sometimes emotion. Price, of course, every seller wants the highest price ever. And then terms is also, we're talking about timeline. The reason why just we kind of talk about don't go to Wells Fargo, Bank of America is because of timing. We have to have a very short escrow. So can a bank really do a 21 days closing? So Marty, tell me, how fast can you close a deal nowadays? Can you close, you know, even shorter than 21 days?
I mean, yes, absolutely. We could close, we could tailor it to what the transaction is needed to be, obviously. Is that a continuous thing that you want to do on every single transaction? Probably not, but yes, absolutely. So one of the strategies that we've been using to fight against the seller's market is for all of you to qualify for a loan and get approved way ahead of time. Be prepared. Put all your documentation with us and let us get you over to an underwriter and get you fully approved. At that point, you have nothing to be afraid of about getting a loan or not getting a loan. If we've already given you that rubber stamp of getting an approval, you can go in confidently in saying, I need a very short timeline for your contingencies or no contingencies on your loan. And that actually prepares us to become in a better situation where we could close the transaction much faster in a 14-day period or 21-day period or whatever. I mean, if we need to meet a closing timeline of 10 days, it's done. It's not like it's not done. It's just a matter of being prepared. And that's majority of what we deal with in the lending process is chasing after getting the documentation from you, the borrower, and then we're just not prepared. We're just chasing it. So it's always good to be proactive versus being reactive to the situation, obviously. So.
Okay, so that's for the timeline. That's very important because nowadays I actually put a lot of offers in with really short timeline, short appraisal contingency and short loan contingencies. That's some of the terms. Besides that, you know, as I say, it depends on who the seller is. If it's an owner occupied, not a flip, you know, a property, sometimes you need to pay attention to details. You may want to write a letter to the seller, you know, trying to find some similarities between you and the seller. Let's say they like X sports team, they like wine. Put in a letter saying that I like your home, I like your color, you know, and a little bit of about yourself. You know, why, you know, this is a good home, a good fit for you. And another thing is that, you know, Chrissy and I have a partner. We use escalation clause, you know, to compete, to win a bidding war. So what is escalation clause? So, you know, it's something that you're willing to pay, let's say 2,000 over the highest and best. So then, you know, then maybe you would have a slight edge to win over the highest and best because you're paying $2,000 over. This is some of the tricks that we've been using. And then most importantly is your agent is willing to pick up the phone and call the listing agent and ask what the seller really wants. Do they actually need to lease back? Are they gonna sell because they want to move somewhere else? They need more time to prep and move and pack up the boxes. Ask them questions. What do the seller want? Do they want longer escrow? Do they, you know, want some other, you know, other terms? So communication is very important, you know, in the entire transaction. So those are my thoughts. So those are my tips. Anthony, do you have anything else to share?
Yeah, those are great thoughts, Cindy. I mean, writing a letter, doing the escalation clause, working with a great lender who's going to be able to do an escrow in as short of a time as period or with no loan contingency is really important. Typically, our escrows are 30 days, right? That's pretty standard. Once in a while, someone pushes to go shorter, but I think the most important thing is getting your paperwork to the lender and getting that approval as soon as you can, even before you write that offer, so that you can enter the contract without a loan contingency, so you can compete equally with the cash offers. So next I wanted to talk for a minute about, you know, when we ask you to expand your areas and look at different types of areas, we also, you know, we'll ask you, do you prefer a condo or a home? And what I hear is that a lot of people are afraid of a condo because they feel like HOA dues may be a waste of money. And they're like, oh, why would I pay $500 a month for HOA? Well, Tim or Karen, do any of you want to talk about like some of the pluses and minuses about condos versus homes?
As far as the HOA goes, even if you're buying a single family home that's not a condo, you should be self-HOAing anyway. You should be putting money aside to deal with unforeseen repairs, which can be a fortune. If you need a new roof, or you need a sewer repair, you know, $20,000, $40,000, $50,000. So, you know, that's like not money that you're going to not spend. It's just, it's going to, a group that's going to take care of all your common areas and all of that stuff. And so in that sense, the HOA is good in a condo because all that stuff you don't have to worry about, and you do generally have a voice in how that money is spent, especially if you join your board or you're active on it. The nice thing about a single family home is that you control everything and you don't have to worry about a homeowners association. Whereas in a condo, you do need approval for certain things. So that's an advantage. And also the getting in price for a condo is going to be less.
Yeah, we have also privacy issues, right? Where you have a home and you don't have anyone above you or below you, which is really nice. And you might have a yard, but if you have a condo, you're not repairing the roof, you know? I love getting my first time buyers into condos because it's a little bit more stable of monthly payment that you'll be making throughout your investment. If your roof leaks and you have plumbing issues, you may have to come up with $10,000 to repair that. If you're in a condo, it's very unlikely that you'll ever have to come up with a large sum of money. If you're in a good HOA, you're paying those homeowner dues every month and they have a savings and they're doing that. And even if there is a large assessment, they usually offer you some type of loan or payment program over time to make some of those payments. So I haven't had any of my clients in my experience get hit with a very large assessment, but I have had homeowners at times where, you know, they have an issue where, you know, there's this earthquake and their chimney cracks and they need to get that taken care of right away, or there's, you know, different issues that will come up. So there are pluses and minuses. There's nothing wrong with condos. I live in one. I love it. easy maintenance. I have a big enough balcony where I could grow all my plants and have a barbecue and sit out there with table and chairs. So it works for me because I'm in the center of the city in West Hollywood, and it's perfect. Eventually, I will love to get a house, but condo is a great investment. Also, one thing that was coming up with Austin and I in our live sessions this week was people were saying, "Oh, is a condo as good of an investment as a home?" And in Los Angeles, greater, in Southern California area, it typically is the appreciation rate of a condo versus a home is about the same. So I'm not sure how it is in other counties or other states, but in Southern California and in big cities, typically the appreciation is pretty much the same for a condo and a home. So don't be afraid of that. So condos or homes could be an option for you. What else did we have? Austin, what's next on our list?
Oh, well, we were going to talk about what happens once you guys get approved. And once you guys find something you like or an offer gets accepted, what happens next? Like, a 3% deposit, scheduled inspection, how much an inspection costs, what goes into an inspection, and when they are inspecting, what are they looking for exactly? That's a great topic. I think a lot of people would ask questions about.
Okay, so the first thing that's going to happen is once you get your offer accepted, you have 3 days to put in a 3% deposit. So typically you want to have that 3% cash on hand to put into escrow as a good faith deposit. Now, that deposit will go towards your down payment of your home, or say you're a vet and your down payment of your home is 0. Any money that you put into that down payment or to that 3% deposit will either go to your closing costs or you'll be refunded at the end. So it's almost just a security deposit to kind of hold your place with that deal. Once you get that in, inspections happen. So Karen, do you want to share with us like some of the types of inspections that you've seen your clients do, or what are the most common ones?
Well, what I also wanted to say is we're dealing a lot, I think, with first-time buyers.
Yeah,
And one of the things that first-time buyers get very nervous. They say, oh, we're putting in an offer. Oh my God, should I really do that? The first thing they have to understand before the inspection is you have contingencies. If you choose not to do that, that's fine. But if you have an offer that has contingencies, you can get out of your offer based on a bad appraisal, based on bad inspection. So you're not tied in forever just because you put the offer in. But I just wanted to say that because I think that's what scares first-time buyers. And after that, the inspections, well, it depends on the property, but you want to do a home inspection. That's a general inspection. And during the home inspection, that inspector will tell you, and you don't want an alarmist, somebody that you want somebody that has a lot of experience and knows really what they're looking at so that they can say, I think you really need to have somebody look at the foundation. I see something's going on, but you need to have an expert look at the foundation. And then they would also, another person that I definitely think you should have is for the sewer line, to make sure, especially a lot of the properties are in the hills and they're in areas where the pipes are so old, they're clay, and they are full of roots or they're cracking. So, and that can be a very expensive thing to replace. So you want to make sure you have somebody in that checks the sewer line. It's a very simple inspection with a video camera, and you'll get the results very quickly. The other thing is you might want to do a termite inspection. LA, don't freak out. All of LA has termites. There's no place you can go in the desert without termites. But the question is, how often when they had it last, did they spot treat? Did they tent? So you want to have all those answers so that you're prepared. And also, if you get down to negotiating after your inspection and you find out the things that you have to deal with, those are the things that you want to talk about in your negotiation. And that would be the next step to do. What do we do now that I've had the inspection? Where do I go from here?
Yeah, thank you, Karen, because that's a great point that you brought up. Just the fact that people do have an out. You write an offer, but you have the ability to do inspections and approve the property's condition. And if you don't approve the condition, you can ask the seller to make changes, or you can ask for a credit. And if you don't get the seller to do that, you have an out and you can get out of escrow, get your full deposit back and move on to your next property. So your only loss is the cost of that inspection you did, which is absolutely worth every dollar. So don't worry. I always say get into the property. After the inspection, if you don't like it, we can always back out and move on. There's also another contingency that we can back out on. So now that there's so many offers happening on properties and people are paying over the list price, you know, buyers are asking me, Anthony, am I overpaying for this property? Am I paying too much? Well, we have a protection measure in place if you're getting a loan called an appraisal. So Marty, Natalie, do you want to talk about that for a moment?
Sure.
Sure.
I mean, we're giving you the money, right? So we want to make sure that we're protected as well. So in a sense, we're protecting you by doing an appraisal. And this is a cost that you're going to incur by getting an appraisal report that you're going to pay for. And it's going to come back to us. We're going to analyze the work of this appraiser's quality of work and if they did a good enough job to make sure that this property is truly appraised for what you're paying for. And it in turn protects you because we're now checking to make sure that the value of the property is there. So we're really truly working for you, but we're also trying to protect our interest in the property as well. So yeah, there's an appraisal contingency. The great part about, like I said, I mean, you know, one thing that Anthony said earlier is working with, you know, bankers like us is going to be the fact that we use local market experts that understand a particular market. And as we know, Los Angeles has a lot of particular pockets, and that one street might be better, way better than the other street. So, so we just really want to make sure that we get the right people, so you're not getting skewed information about the property value. So, and you get the accurate information of what you're paying for, basically. So.
Yeah, no, thank you so much for that. So Cindy, Tim, Karen, thank you guys so much for your input. And now if there's anyone has any questions, feel free to unmute yourself and ask or type them into the chat function and we'll answer them there. There was one question that Don just asked and he was asking about the timeline for inspections. There absolutely is a timeline, like Cindy said. The contract stated it's like 17 days, but usually it's something that we recommend that you do the first 5 days of being in escrow, that you get it done right away. It's one of the very, very first things that you schedule because you want to know that condition of the home before you move on, before you get too involved in the loan and the appraisal and moving forward. So the inspection happens as soon as you can. And it's the general inspection, you know, like Karen said, and if there's any other side inspections like termite or sewer line or chimney, or anything like that, the general inspection or your realtor will guide you on that. There's a lot of companies out there, real estate companies who they don't recommend home inspections and they're just there to kind of close the transaction and not completely protect you. So make sure you have a great, you know, realtor and company that's really out there to protect you, that's full-time, and that's going to make sure that you're doing all the inspections possible to save you enough money in the long run and to make sure that your wealth is being protected. So the worst thing that could happen is you buy a house and then, you know, a month later you found out the foundation is cracked and that's $100,000 issue. The foundation didn't crack after you bought your house. It takes a big event for that to happen. It was there and you just missed it. So that was something that you should have found out with your general inspector or your realtor should have been able to recommend having a foundation person come in and take a look at that property. So, you know, we're here to protect your wealth and help you grow. It might seem overwhelming, right? That buying a house is so many different steps and things to it, but you guys have taken the first step now that you've attended a home buyer seminar. Second step is calling a lender and finding out your personal situation with that lender and seeing what price range you'd qualify for or what it takes for you to actually qualify for a home. And then the third step is meeting with that realtor and going shopping and discovering neighborhoods and types of properties that fit into that price range. So congrats on taking that first step. That's awesome. Now your next challenge is talk to a lender and reach out to them and see where you really fit. So yeah, let's get to some questions. Austin, is there anything in there?
I see one from Marisol. She's talking about buying. I'm assuming you're renting at this point, and you're wondering should you buy or buy and start initially with investments. The answer is yes. Basically, getting out of your rent unless you're paying really cheap rent is, would be my first priority. I'm working with 2 clients that are living basically for free with family, and they're doing their investment first. But for most people, I would say get your own home and your rent, and if you want to combine them, buy a duplex or a triplex and live in one of the units. Is another thing to consider.
That's fantastic. We actually do have a lot of, we have a question from a young freshman in college, 18-year-old no stable income freshman in college. What's the most ideal loan program for young children like that? Not children, grown-ups, adults. Anything that an 18-year-old or someone that really is passionate about real estate, what's something that they can do at your advice?
Something happened to Austin's.
Yeah, no, Marty, please shoot me the answer to that. What can a young person do?
Programs for younger people, I would say there's no one particular program. Those programs are really equivocally done for equal opportunity for everybody to be able to borrow in similar circumstances. But there's really, my advice is going to be for a younger person is to really make sure that they focus on their credit and also, create a stable income stream, so they don't find themselves in a situation where they're not able to make that mortgage payment down the line. If it's an investment, it's going to be obviously requiring for a little bit more than the 0 down or 3% or 5%. Generally, investment properties are going to require you to put down 10 to 20% down minimum. But yeah, like there's really, I don't know of any particular programs that are specific for younger people. That's not, it's generally equivocally done for equal opportunity reasons.
Okay, well, what circumstances would require a cosigner? Our friend Stephanie asked that question. Like she wants to, I guess, get a property, but what circumstances would require a cosigner?
Natalie, I've been talking a lot. Why don't you take this one? So.
Sure. Cosigners are needed occasionally if the income isn't quite enough and they want to qualify, let's say, for a higher property because they have a roommate and they know they're making a little bit more money, so they want to take the qualification a little bit higher than what they themselves alone can qualify for. So a cosigner at that point is always helpful. Depending on down payments, sometimes we do cosigners instead of gifts. It depends on the kind of file, like for an investment property. But normally you add a cosigner on if there's a little bit of trouble with income or just not enough income being earned. Or if somebody has a lot of debt and okay income, but the debt is kind of taking away from the income, then we'll add a co-borrower on there as well. But normally we add co-borrowers just because of a debt to income ratio issue.
Oh, that's a good answer. Our friend Carol asked a good question. When buying a duplex, would the income from the rent be taken into account if the income of the person is not high enough for a loan? She says,
Yes.
sorry, I'm not sure. I'm wondering if the question is correctly.
Yeah. And we do it all the time. It's a great way for somebody who has a high debt to income ratio. Sometimes instead of putting a co-borrower, I'll say, listen, on your own for a single family, you only can afford around $350,000. But if you get a duplex and now I can use the income from the second unit coming in, now you can afford $700,000. So it can absolutely help and very meaningful to get the duplex if somebody's income isn't quite enough.
It's a really smart way to invest. I mean, if you can buy your first home as a duplex or triplex and live in a unit, you're going to be building wealth so much faster than someone who buys a condo to start. So one question from Dawn, I think we skipped. True or false? You can get an FHA loan only once in your lifetime.
False. I have a client that I've given her like 10 FHAs. She just like buys duplexes with FHAs, gets out of the FHA into a conventional, buys another duplex with FHA, gets out of it, gets into another. So as long as you can only have one FHA at a time. That's how FHA works. Only one at a time.
It needs to be your primary resident. You need to be living in that unit.
Always, hands down, always. FHA is an owner occupied program.
Another interesting question that we get for younger people as well too, and maybe not just younger people, I don't want to generalize, is roommate income. I've gone that in groups of, when we're doing first time home buyers, you really can't use roommate income on most programs. There are very specific programs that will allow for boarder income or roommate income. So just wanted to let you know that that's not a general, like I get a question, they're like, well, I'm getting a roommate. I'm gonna rent out every room in my house. So that's not generally an income source that we could use, but the duplex piece is obviously an income that could be used, but it can be used at certain times, obviously, because we've got family members living together that get Social Security income and things of that nature that, multi-generational. So there's some programs that allow for that kind of use of income as well.
There was a follow-up question to the cosigner. So this is from Brian, and he's asking, can't the cosigner income and credit for a partial percentage of ownership of the property? I heard of this happening for people who struggle providing their income, but they can make the payments. So can he use the cosigner's income and credit for a partial percentage of the owner's property?
Usually when you're having a cosigner, you're going to get generally 50%, but you could dictate on your, I don't want to use the word listing because it's a big word in this moment, but on your actual deed of trust, allocate any percentage that you want to your cosigner. You could give them 1% to 100% to 99%, whatever you want to do. But generally in our eyes, you guys are 50-50 from a lender's perspective. You're both responsible for that mortgage equivocally.
As a liability.
Yeah.
I just posted Natalie and Marty's info in the chat again. And someone asked, is there any free consultations with the lender that are available? Can they meet with you, get all their details free, really figure out their personal situation?
Always.
$1,000 an hour. I'm kidding. It's free. It's free, guys. So by all means, we love to make homeownership happen. It's actually it's an honor to help you guys to get into a home. So absolutely, please reach out to us.
Awesome. And I know a lot of you guys are in SoCal and we work all over Southern California. If you happen to not be in the area, please let us know. We have amazing realtor connections that are like-minded and think like us in many, many cities across the country. So reach out to us first and we'll be happy to connect you with a great realtor if you're looking at buying now or next year or whenever, and connect you with those people down the road. So think of us for all your real estate needs. Another question, what do we have here? Oh, wow, this is a long one. Francia, do you want to unmute yourself maybe and ask it? Just in case there's a conversation that needs to be had.
I know it's really long and kind of complicated. Okay, well, I bought 2 units in North Hollywood about 4 years ago. That was my very first purchase. And in August, a few months ago, I bought a single family home right next to it. And I want to refinance. So I've been looking, actually tried with 2 different brokers to refinance the 2 units. They were already appraised. They came out to be a little bit over $1 million. But I wanted to do a cash out too. So I wanted to lower my interest rate and get as much of my equity out so I can purchase another property. But I encounter a little bit of difficulty because I was getting a really good interest rate through Quicken Loans, but they would only offer me $80,000 cash out. And then I tried with a different broker, and she tried the NONI program, which would increase my interest rate and would give me $151,000 cash out. And then I talked to somebody else who said, why don't you try the HELOC So you can get more money out. Since your property was appraised for $1 million, you have about 400,000 equity. But then I was wondering, can I refinance to get the lower interest rate and do the HELOC? I mean, I'm just confused. I don't know what's my ultimate best option. I feel like I have equity stuck and I don't know how to get it out and how to get a better interest rate.
Is your
think-
existing loan a owner-occupied loan? Is that what it is?
Huh?
Is your existing loan an owner-occupied loan? And what
Yes.
are you at right now? I'm just curious. It sounds very specific to your situation, so it seems like a longer conversation than
I
this.
know.
but-
Yes,
You might
yes.
wanna- You might want to just call one of us
Yeah.
and we can take you.
Okay,
But
okay.
yeah, a lot of the time it is better to just do a standard refinance, lower the rate, and then do cash out through a HELOC after.
Okay,
I think
Thank
it's
you.
totally doable. You can definitely take that cash, and it just depends. There seems to be something that's missing in this conversation that we're missing, but yeah, absolutely, you could definitely take as much as up to 80% of the value of the property.
okay. Thank you.
Of course. Thank you for the question.
Yeah, and if any of you guys have any other questions, these guys are perfectly happy to set up like a personal Zoom call with any of you. You guys can FaceTime, text, go to each other's birthday parties. I don't care. It's gonna be fun, and you guys are they're very fine and kind people. They are more than happy to take out time out of their days to help you. So thank you to Natalie and Marty for being here and answering their
Thank you,
questions.
guys.
Fills my heart with joy.
Yeah, thank you guys so much for joining us. If you go to our website, The Collective Realty, you'll always see all the different events we have that are upcoming. Like we said, we're going to be emailing you a list of our upcoming events. You'll get that tomorrow. We have a great YouTube channel with many, many webinars we've done in the past, and we'll keep adding to that. So we'd love for you to subscribe and follow our YouTube channel. And anything else we can do in the future to help out, let us know. You know, I know a lot of you guys are very experienced in this, and some of you are new, and we're here and just so passionate about helping you build wealth no matter where you are. Remember, it's the #1 way to build wealth in this country is through owning real estate, and we just want to get you on that path step by step. Whether you own now or whether you're looking for that first home, we want to make it as easy and as clear as possible and help you build as much wealth as possible. So again, thank you guys so much for coming. This session will be live, or not live, will be posted on our YouTube channel tomorrow in case you missed part of it or want to review any of it. I'm going to just post our last poll of the day just to see, am I able to do this? I just want to see if you guys would be willing to rate our session today, and maybe not. Well, if you want to just type it in the chat, if you want to give it 1, 2, 3, 4, or 5 stars, so we know how we did, and we'd always like to improve, or any other comments that we could do to improve or make anything better for you, please feel free to share that, and join us next time. We'll see you guys soon, hopefully. Have a great week and stay safe with COVID.
Thank
Thank
you
you,
for all the
Natalie.
love on
Thank you,
TikTok,
Austin.
you guys. It really changed my life, and being able to talk to you guys on live every night with Anthony's great. I have such a fun time making videos and just informing you guys the best way I can. I know most of you guys found this seminar through my TikTok page. Bless all of you. You all are amazing.